Good afternoon, Matt Giles back here with a market update for you. Today is Thursday, March 17th, and yesterday the Fed raised rates for the first time since December 2018, a move that's been widely anticipated since December of last year. As a reminder, the Fed's main job being twofold: to keep unemployment low and to maintain low inflation. Well, with unemployment being right in the Fed's sweet spot, the Fed, of course, is focusing on what many of us are also probably focusing on: inflation. And one of the Fed's favorite tools to combat inflation has been to raise short-term interest rates to hopefully cool off the economy and tame inflation. Now that the Fed has begun its hiking cycle, that begs the question, what comes next? Well, of course, no one can predict the future, but more important to us, how should we be thinking about this? First, we need to remember Fed rate hikes usually happen near the middle of the economic cycle, with potentially years left of growth in stocks and the economy. And actually, a year after the first hike in the cycle has been fairly strong. Higher a year later, the past 6 times, which we'll take a closer look at in just a minute. The Fed hiked 0.25%, which is considered one hike. Now, we've looked at this before. How many hikes are priced in? Going into yesterday, there had been a 90% chance of 2 hikes priced in, and we only got 1. So beware when you hear on the news 7 hikes are priced in or 5 hikes are priced in. That's forecasting an unknown future, and like many forecasts, it's often wrong. Actually, you can see for the last 8 hiking cycles since 1983, the Fed rarely kicks off a hiking cycle with more than 1 hike. But the drama makes for great breaking news and keeping us on high alert. Always gotta be on high alert. But the Fed can hike more than once, and often does, just a little later into the cycle. Even so, look at this. During periods of extended rate hiking cycles, more often than not, stocks have done just fine. It's not 100%, and each cycle is unique in its own right, but this just goes to show that the beginning of a rate hiking cycle is not the end of the world for the stock market. And going back to the number of hikes, right now, for example, there are over 6 hikes priced in, right? Beware of how many hikes are priced in. But how realistic would it be to have even 4 or 5 hikes in a year? So going back to 1970, more years than not have actually had 4 hikes or more per year. In more recent times, that hasn't been the case as much, but the last hiking cycle in 2018 did have 4 hikes in 1 year. Again, we've seen this before, and we're still here to tell the story about it. A hiking cycle alone did not permanently ruin the stock market or the economy. Speaking of, when you look at just those years with 4 hikes or more, while there were some very volatile years in the mid-70s cycle, remember those years were accompanied by extremely high inflation that lasted for years and years, and dozens of rate hikes per year. What has our attention more is the mid-2000s cycle, each featuring from 4 to 8 hikes per year, with positive stock market gains in each of those years. Bottom line is, rate hikes usually aren't bearish events, and we don't expect this cycle to be any different. Not necessarily straight up, and not all blue skies with 0 volatility. But if we can extend out our time frame a couple years, as we just looked at, usually this has led to decent outcomes. Thanks for watching, and please reach out if you have additional questions or concerns. Thank you.